Hey guys, welcome back to Father and Son Investing. This is the Treasury Bill update for July 2023. I know it's a little bit before July, but the 4th of July is coming and people are going to be busy, so we're going to get this one out just a little bit early. I will give you the bottom line up front for this video, and that is patience. I'll explain to you what I'm talking about. There are important things that are going to be happening during the month of July, not the least of which to mention is going to be the Fed meeting near the end of July. So let's get to today's topic. First of all, let's just cover what Treasury bills have been doing lately. Let's quickly look at the graph of how things have gone since the beginning of this year. We'll bring in each of the Treasury bills by different color and date. You can see the legend there at the bottom. What do you see here? You see that the trend is on its way up, except for that weird blip of the 4-week Treasury bill, which I explained in previous bills and we won't go over. Also notice that right after President Biden signed the bill that created the pause in the debt limit, we see that the Treasury bill yields actually came down just a little bit, but they are now starting on their way back up. Now, in the last video, I explained that I thought that the floor for Treasury bills would be right around the 5.05% level, and I explained why that had to do with the overnight repo facility that the Fed runs. If you're not familiar with that, go back and watch the last video that I did on the Treasury bill update. If we look at the graph here, then we'll see that the 4-week Treasury bill really is hanging right in there around that 5.05 level. The other Treasury bills, of course, are behaving the way that they should be, actually. We should see that the longer duration Treasury bill you purchase, the better yield you get, and that is the case that's happening. The 52-week Treasury bill, of course, is the exception in here. We'll see that the most recent round that occurred around June 15th, the 52-week Treasury bill was actually yielding less than many of the other Treasury bills, except for the 4-week Treasury bill. Now, I mentioned at the beginning that the theme for this video is going to be patience. There's an interesting article here in Market Watch. It's going to talk about a report from Bank of America, but essentially the title says, "Wait for Treasury bills to cheapen as Treasury keeps up issuance deluge," says Bank of America Global Research. In here, the author of a recent client note in the Bank of America Global Research System says, "We continue to believe bills are still biased cheaper in the weeks ahead," meaning that the yields will go up, the price will be going down. As part of the research that this team at Bank of America Global Research did, they took a look at periods of heavy past bill supply when the U.S. government was issuing a lot of Treasury bills. And what they see in their research is that the 3-month Treasury bill versus the benchmark overnight index swap, that is the overnight Fed repo facility that we'll touch on again here in just a minute. Based upon using that as the benchmark, they see that the rate should cheapen roughly 5 basis points for every 100 billion of net new supply. Now remember that the government is going to be issuing about $1.4 trillion worth of Treasury bills through the next 6 months, according to Bank of America. And so what that would equal out to is about a 76 basis point relative cheapening or decrease in that price for 3-month Treasury bills. Now, quickly going back to the graph that I showed you earlier, we see that that hasn't quite happened yet. I mentioned that right after President Biden signed that bill, that the yields on Treasury bills actually went down. Now, this has been attributed to people just being excited about being able to purchase all of these Treasury bills. But there are some factors that are going to drive the Treasury yields up or the price of a Treasury bill down. Let's discuss those. All right, the first factor I want to discuss is this overnight reverse repurchase agreement, this repo facility that the Fed runs. Essentially, people park their money there as a way to do some short-term borrowing and lending overnight, essentially. And there has been $2.3 trillion, up to $2.3 trillion within that overnight repo facility recently. A lot of that money is coming from money market funds, and they're earning 5.05% there from the Fed. Now, in order to coax these money market funds to get their money out of the Fed and buy Treasury bills, the Treasury is going to need to increase the yield or lower the price of these Treasury bills. That's why I said the floor should be 5.05%, because that's what these money market funds can earn at the Fed repo facility. Now, if we look here, after President Biden signed that bill, we do see that this has come down a bit. It's now down to about just shy of $2 trillion. It says $1.994 trillion there. So they have managed to get some of these money market funds to get their money out of this overnight repo facility, and we'll assume that some of that money, or a lot of that money, went into purchasing Treasury bills. But this is not a big move here, going from about 2.3 trillion down to 1.99 trillion. So in my opinion, in order to get a little more of this money out of this overnight repo facility and get people, or get these money market funds buying Treasury bills, the yields on these are going to have to go up to make it worth their while to move the money. Now, as the next part of this discussion, I'm going to nerd out a little bit here on you, but I want to teach you something about Treasury bills and how you can figure out the demand for bills and therefore where the prices or the yields may be going. Whenever there's a Treasury auction, typically there's more money being put forth for potential buying of Treasury bills than the actual auction will be. Here's an example of that. In this auction, which recently took place, there was $164 billion worth of money tendered for the auction, and only $61 billion and some change was accepted. So we can see that a lot more money was put forth wanting to buy Treasury bills than which was actually accepted by the Treasury. This actually goes by a particular name. If you scroll down here, you'll see this thing that says bid to cover ratio, and it will tell you what that ratio is. It's essentially the amount of money that was put forth divided by the amount that was accepted. So in this case, for this auction, the bid to cover ratio was 2.58. Now, I'll tell you that a bid to cover ratio 2 or greater generally means that there was an enthusiastic demand for the particular auction, whatever the Treasury was auctioning. When it starts getting below 2, well, then the demand is less. Obviously, if it gets to 1 or below 1, that is a big problem. When it gets less than 1, that means essentially that it's called an auction failure, that the government wasn't able to sell as many Treasury bills or notes or bonds as they were trying to. With that in mind, I've gone ahead and created a graph just to show you what this bid to cover has looked like, at least for the 4-week, the 8-week, and the 17-week Treasury bills going back to about August of last year. So if I bring these in, there's the 4-week bid to cover ratio. We'll bring in the 8-week bid to cover ratio and the 17-week bid to cover ratio. And if you try to pick out a trend of what's going on here, trying to pick out a trend here is actually quite difficult. But I would say that at least in recent days, the bid to cover ratio has gone up, meaning that there's been enthusiastic demand for these Treasury bills, and that's partly why the Treasury bill yields have not been going up, because of this demand, which I showed you on the other graph. However, here is one important factor that we need to keep in mind, and that is, according to this article in CNBC, the Fed still forecasts 2 more rate hikes in 2023, taking rates as high as 5.6%. Now, of course, in the most recent meeting in mid-June, the Fed essentially did a skip, not a pause. They weren't pausing rate hikes. They were just skipping 1 month in there. But I think many of the analysts are saying that in July, the Fed is going to go ahead and raise rates again by a 1/4 basis point or 0.25%. Now, this is the famous Fed dot plot, and it agrees with what I was just saying. You can see what the different members of that Fed committee, each dot represents one of them, have been predicting in terms of where they think the Fed funds rate needs to be sitting at. We'll see that the bulk of them are going to be here at this 5.6% and above range, with a few outliers down below. Of course, as we get into 2024 and 2025, you can see what they predict those Fed funds will be doing. They're going to be coming down, but they're not going to go back to what they were pre-pandemic. Getting back to the theme of this video as we wind up this discussion, let's go back to the Bank of America report here. Bank of America still thinks continued aggressive tones from the Fed on interest rates, which I just mentioned, as well as other factors, will favor investors who wait. The bottom line says, be patient in the face of supply to allow for cheaper Treasury bills. Cheaper bills mean higher yields. So what am I looking at in terms of Treasury bills right now? So which Treasury bill do I like right now? I like the 8-week Treasury bill. You're getting a little bit better yield than the 4-week Treasury bill. You're right on par, actually, with the 13-week Treasury bill, and really not that much behind the 17-week Treasury bill. That's going to keep you within that range of the next Fed meeting. Yes, it will go a little bit past then, but after the Fed raises their rates, as I expect they will in July, your next Treasury bill purchase can be at a higher yield. That's it for today's video. I hope this information was helpful for you. If it was, please give us a thumbs up and share this information with Treasury bill buyers that you know. As always, share this information with a young person in your life. Help them get a good start on their investing career. Until next time, enjoy your investing.